Something unusual just happened inside the US Treasury market, and within hours, gold reacted in a way that should get every precious metals investor's attention. The US government stepped into its own long-term debt market and increased its purchases of previously issued Treasury bonds, and almost immediately, the market responded. Gold moved above $4,500, silver surged, Treasury yields fell, and the dollar came under pressure. But the price move is only the surface of this story. The real question is why the Treasury is becoming more active in the long end of the bond market, and what that could mean for gold and silver from here. I'm Alex James, an independent economic gold and silver analyst, and this is Macro Bullion. Today we're going to break down the mechanism behind this move in plain English, because understanding what happened is far more important than simply watching the gold price move higher. The source material identifies August 19th and 20th as the key dates, when the Federal Reserve's July meeting minutes arrived at almost the same time as the Treasury announcement. But according to the source, it was the Treasury's decision to increase long-term bond repurchases that produced the immediate reaction across precious metals. So what exactly did the Treasury do? The government announced that it would increase repurchases of longer-term Treasury securities, including 10-year, 20-year, and 30-year debt. In simple terms, the Treasury went into the market and bought back some of the debt it had previously issued. Now, that might sound like a technical accounting exercise, but it has a direct impact on bond prices and yields. Think of a Treasury bond as an IOU from the US government. Investors provide money to the government, and in return, they receive interest and eventually their principal back. But once that bond is trading in the secondary market, its price can move up and down. And here's the critical relationship. Bond prices and yields move in opposite directions. When demand for bonds rises, bond prices rise. Because the underlying interest payment is fixed, the effective yield falls. When bond prices decline, yields rise. So when the Treasury buys long-term bonds, it creates additional demand for those securities. More demand can mean higher bond prices. Higher bond prices mean lower yields. And that is exactly what the market immediately began pricing in. The source reports that the 10-year Treasury yield fell more than 5 basis points, while the 30-year yield dropped around 9 basis points on the announcement. Now here's where this becomes directly relevant to gold. Gold doesn't pay interest. There is no coupon attached to an ounce of physical gold sitting in a vault. If you own gold for a year, the metal doesn't send you a monthly payment. That means investors compare gold with yield-producing assets, such as Treasury bonds. When Treasury yields are high, holding gold has a higher opportunity cost because you're giving up that potential income. But when yields fall, that opportunity cost becomes smaller, and suddenly gold becomes more competitive. That's one reason lower Treasury yields can create a supportive environment for gold. But there was another force moving at the same time. The US dollar weakened. And this is where the story becomes even more important. Gold is priced globally in dollars. So when the dollar weakens, the dollar-denominated price of gold can rise even if the physical metal itself hasn't changed. The source describes the Treasury announcement as producing both forces simultaneously, falling yields and a weaker dollar. That combination is extremely powerful for precious metals. Lower yields reduce gold's opportunity cost. A weaker dollar can increase the dollar price of gold. And when both happen together, the market can move very quickly. That's exactly what we saw. Gold moved above $4,500, while silver pushed higher as well. But I don't think the most important part of this story is the one-day move in gold. The bigger story is what this intervention potentially tells us about the US government's relationship with its own debt. Because there is a huge difference between a government simply issuing bonds to finance spending and a government becoming increasingly interested in managing the cost of its existing long-term debt. And when the 30-year Treasury yield had already climbed to its highest level since 2007, that pressure became much harder to ignore. So now we have the real question. Is this simply routine Treasury debt management, or are we watching the beginning of a much bigger struggle to keep long-term borrowing costs under control? Because if the answer is the second one, then this story isn't only about Treasury bonds, it's about the dollar, it's about debt. And ultimately, it's about why gold and silver could remain at the center of the macroeconomic conversation. Where silver enters the picture, because silver is reacting to the same monetary forces as gold, but it has another engine underneath the market, industrial demand. The answer starts with the 30-year Treasury yield. In the days before the announcement, the 30-year yield had reached its highest level since 2007. That means the US government was facing borrowing costs at levels not seen in almost 2 decades. And when you are dealing with a government carrying an enormous debt burden, higher interest rates aren't just a problem for traders looking at a chart. They eventually become a budget problem. Think about it from a personal perspective. Imagine you have a very large mortgage that was originally financed at a low interest rate. Then, over time, the cost of refinancing rises dramatically. The more debt you have, the more painful that increase becomes. The same basic principle applies to the US government. The more debt that has to be refinanced at higher rates, the greater the potential interest burden becomes. The source estimates US national national debt at roughly $37 trillion and points to projections that annual interest payments could eventually exceed $1 trillion. That is why the long end of the Treasury curve matters so much. If the Treasury can create additional demand for longer-term bonds, it can potentially push their prices higher and yields lower. And that's exactly what happened immediately after the announcement. The 10-year yield fell more than 5 basis points, and the 30-year yield dropped around 9 basis points. Now let's connect that directly back to gold. Gold has a unique problem compared with bonds. A Treasury bond can provide interest income. Gold cannot. So when a 30-year Treasury is offering an attractive yield, institutional investors have to consider what they are giving up by holding gold instead. That is the opportunity cost of gold. When yields rise, that opportunity cost increases. When yields fall, that opportunity cost decreases. And when the Treasury announcement pushed long-term yields lower, the relative attractiveness of gold improved almost immediately. But there was another catalyst working at the same time. The dollar was falling. And that matters because gold is priced in US dollars. Imagine that the physical gold itself hasn't changed at all. If the purchasing power of the dollar declines relative to other currencies, it simply takes more dollars to purchase the same ounce of gold. So you can have a rising gold price without the physical metal becoming any different. The change can be coming from the currency. That's exactly why the combination of falling yields plus a falling dollar is so important for bullion investors. The source describes both forces operating simultaneously during this move. And this is where the story starts moving beyond a simple technical gold rally, because the market isn't only asking, what is gold worth today? It's also asking, what is the dollar going to be worth tomorrow? That is a much bigger question. If investors believe the US government is becoming more sensitive to rising long-term borrowing costs, they may start thinking about the longer-term implications for fiscal policy and currency purchasing power. Now, I want to be careful here. The Treasury's action should not automatically be described as full-scale quantitative easing or formal yield curve control. The source itself makes that distinction. It says the Treasury described the operation as routine debt management, while acknowledging that the move deserves attention because of the broader debt environment. So we shouldn't jump from one bond buyback announcement to the conclusion that the US has suddenly adopted Japan-style yield curve control. That's not what the source establishes. What it does establish is that the Treasury is actively buying back longer-term debt at a moment when long-term yields had become uncomfortable. And that is significant by itself. Because once policymakers begin paying closer attention to the cost of long-term borrowing, precious metals investors need to watch what happens next. Does the Treasury continue increasing its intervention? Do long-term yields remain suppressed? Does the dollar continue weakening? Or does the bond market eventually push yields higher again despite the government's efforts? Those questions could determine the next major move in gold. And there is another complication. At almost exactly the same time, the Federal Reserve was sending a very different signal. The July Fed meeting minutes showed that 3 members of the Federal Open Market Committee wanted higher interest rates rather than maintaining the existing range. The committee ultimately voted 9,3 to hold rates at 3.5% to 3.75%. Think about what that means. On one side, you have the Treasury trying to reduce pressure at the long end of the bond market. On the other side, you have some Fed officials arguing that rates may actually need to go higher. Those are two very different forces. And that tension could become extremely important for gold and silver, because if the Fed becomes more hawkish, Treasury yields could come under renewed upward pressure. But if the Treasury continues trying to keep longer-term borrowing costs contained while the dollar weakens, precious metals could receive another powerful tailwind. So this isn't simply a story about what happened this week. It is becoming a battle between fiscal pressure, monetary policy, bond market demand, and currency confidence. And gold is sitting directly in the middle of that battle, but silver may have an even more explosive setup, because unlike gold, silver isn't only responding to monetary conditions, it also has a major industrial demand story underneath it. And when that monetary catalyst hits a smaller market with significant industrial demand, silver can move much faster than gold. That is exactly what we're going to examine next. This week's move made that difference obvious. The source reports gold gaining roughly 3% across the week, while silver surged more than 5%, with silver moving back above $70 an ounce. Why can silver move faster? One reason is simply market structure. Silver is a much smaller market than gold in terms of total dollar value. So, when substantial amounts of capital move into precious metals, the same amount of buying pressure can produce a much larger percentage move in silver. But that works in both directions. When investors become aggressively bullish, silver can outperform gold. When sentiment reverses, silver can also fall much harder. That's why silver is often called the higher volatility member of the precious metals complex. But market structure isn't the only reason I'm watching silver. The second reason is industrial demand. According to the source, more than half of global silver consumption goes toward industrial uses rather than jewelry or investment. Silver is used in solar technology, electric vehicles, electronics, and electrical systems because of its exceptional conductivity. That creates an interesting setup. Gold is primarily responding to monetary conditions, currency concerns, real yields, and investor demand. Silver can respond to those same forces while simultaneously responding to industrial demand. So when the macro environment becomes supportive for precious metals, silver can potentially get a double tailwind, and that may help explain why its percentage move has been stronger. There is another metric that precious metals investors watch closely, the gold to silver ratio. The source puts that ratio around 65.7, meaning it takes almost 66 ounces of silver to equal the value of 1 ounce of gold. The ratio doesn't tell us exactly where silver will trade next, but it provides context. And if the precious metal cycle continues broadening from gold into silver, a declining gold to silver ratio would indicate that silver is outperforming gold. That's something I would watch closely. But there is a much bigger story developing behind both metals. Central banks are continuing to accumulate gold. The source reports that central banks purchased 288.9 tons of gold during the second quarter of 2026, describing it as a quarterly record, while also citing expectations for continued strong central bank demand. Now, this is important because central banks aren't typically buying gold because they saw a 5-minute chart and decided to chase momentum. Their time horizon is much longer. They manage national reserves. So when official institutions increase gold allocations, investors need to think beyond the next trading session. The question becomes whether this is part of a longer-term diversification trend, and if central banks continue buying gold while the U.S. government becomes increasingly focused on managing long-term borrowing costs, the two stories begin to connect. On one side, you have governments accumulating gold as a reserve asset. On the other, you have the world's largest government actively managing its long-term debt market, and sitting between those two forces is the dollar. That is why I don't think we should analyze this week's gold move in isolation. The Treasury announcement was the catalyst, but the underlying story is much broader. Debt, yields, the dollar, central bank reserves, gold, and silver. All of these markets are connected, but there is one major risk that could disrupt this bullish precious metal setup, and it comes from energy prices. The source points specifically to the continuing US-Iran situation and the Strait of Hormuz. If geopolitical tensions push crude oil substantially higher, the resulting increase in energy prices could revive inflation concerns. And that creates a very important chain reaction. Higher oil prices can increase inflation expectations. Higher inflation expectations can make the Federal Reserve more reluctant to cut rates or potentially more willing to raise them. Higher expected rates increase the opportunity cost of holding gold. And suddenly, the same precious metal market that benefited from falling yields could face a completely different environment. The source says this exact sequence occurred earlier in 2026. Geopolitical escalation pushed oil higher, inflation expectations increased, markets became more hawkish on the Fed, and gold subsequently experienced a major correction from its earlier high. That historical example is important because it reminds us that gold is not automatically bullish just because geopolitical risk is rising. Sometimes geopolitical risk pushes investors into gold as a safe haven. But if that same geopolitical event creates a large enough oil shock, it can also produce inflation and higher interest rate expectations. Those forces can work against gold. So right now, the market has a genuine tug of war. The Treasury wants to reduce pressure on long-term borrowing costs. Some Federal Reserve officials are pushing for tighter policy. The dollar is under pressure. Gold is breaking higher. Silver is outperforming. Central banks remain major gold buyers. But energy prices remain a potential wild card. And that brings us to the most important question of the entire analysis. Which force wins? Does the debt and dollar story dominate, or does inflation and higher energy prices force the Fed to stay hawkish? Because whichever side wins could determine whether this week's gold and silver surge becomes the beginning of another major leg higher or simply another sharp rally followed by a correction. And that is exactly what we need to examine next. The next question is whether this move in gold and silver can actually continue. And to answer that, we have to stop looking at the precious metals charts in isolation and look at the conflict developing between the Treasury and the Federal Reserve. Because right now, these two institutions are sending the market very different signals. The Treasury wants lower long-term borrowing costs. Its decision to increase purchases of longer-term Treasury debt immediately pushed bond prices higher and yields lower. The source reports the 10-year yield falling more than 5 basis points and the 30-year yield dropping 9 basis points on the announcement. But the Federal Reserve has a completely different problem. The July meeting minutes showed that 3 of the 12 FOMC members wanted rates to be higher. The final vote was 9-3 to maintain the 3.5% to 3.75% range. That creates a very unusual situation. The Treasury is effectively trying to reduce pressure at the long end of the curve, while some Fed officials are arguing that monetary policy may need to become tighter. And remember, the Federal Reserve controls the short-term policy rate, while market forces have much more influence over longer-term Treasury yields, so the Treasury can buy bonds and create demand. But it cannot simply force every investor in the world to accept lower long-term yields indefinitely. Eventually, investors decide what return they require, and that's why the next few weeks could be extremely important. If long-term yields remain contained while the dollar continues to weaken, that would keep the environment supportive for gold. But if inflation begins accelerating again, especially because of energy prices, the Fed could become more hawkish, and that could put upward pressure on yields. This is where the Iran situation becomes so important. The source identifies the Strait of Hormuz and potential new sanctions against Iran as a major risk for energy markets, with Brent crude pushing toward $93 a barrel. Why should a gold investor care about oil? Because energy is one of the most important inputs into the entire economy. When crude rises sharply, transportation becomes more expensive, production becomes more expensive, shipping becomes more expensive, and eventually some of those costs can flow into consumer prices. That can change the Federal Reserve's reaction function, and we already have an example from earlier this year. According to the source, when geopolitical escalation pushed Brent crude above $126, inflation expectations increased and markets began pricing a more hawkish Federal Reserve. Gold then suffered a major correction from its earlier high. So this is the paradox. Geopolitical risk can be bullish for gold because investors want a safe haven asset. But if that geopolitical risk creates an oil shock, the resulting inflation can push interest rates higher, and higher rates can become bearish for gold. That means we cannot simply say Iran tensions are rising, therefore gold must go higher. The actual question is, what does the oil market do next, and how does the Federal Reserve respond? That is the variable I would monitor. Now let's come back to the dollar. The source describes the Treasury announcement as producing a weaker dollar at the same time that yields fell. That combination is one of the strongest short-term environments for precious metals. But again, we need confirmation. If the dollar starts recovering while Treasury yields rise, gold could face resistance. If the dollar continues falling while yields remain contained, the bullish case becomes stronger. And if gold holds above the $4,500 area after breaking through it, that would be particularly important because it would show that buyers are willing to defend the new higher price zone rather than simply reacting to one headline. Silver needs even more confirmation. The source reports silver breaking above $70 and gaining more than 5% during the week. But because silver is a smaller and more volatile market, I would not treat a rapid surge as proof that prices can continue rising at the same speed. Silver can move aggressively in both directions. That's why the gold to silver ratio is useful as context. At around 65.7, the source says the ratio remains above the long-term range. It identifies as roughly 40 to 60. If that ratio begins falling, it would mean silver is outperforming gold. And if that happens while the dollar remains weak and precious metals demand stays strong, silver could become one of the most interesting parts of this entire cycle. But there is another factor that makes the long-term story different from the short-term trade: central banks. The source reports that central banks purchased 288.9 tons of gold in the second quarter of 2026, describing it as a quarterly record. That is important because central bank buying operates on a completely different time horizon from day traders. A trader can buy gold because yields fell today. A central bank can buy gold because it is thinking about reserve diversification over the next decade. Those are very different motivations. And when you put the two together, strong official sector demand and a market increasingly focused on U.S. debt management, you get a much broader structural narrative for gold. But I want to keep one thing very clear. None of this guarantees that gold goes straight up. Markets can reverse, yields can rise, the dollar can strengthen, oil can create inflation, the Fed can surprise investors, and silver, because of its volatility, can experience much larger corrections than gold. So the key isn't to predict every candle. The key is to understand the forces behind the candles. Right now, those forces are pulling in different directions. Treasury intervention is pushing toward lower long-term yields. Fed hawkishness is pushing toward tighter financial conditions. Dollar weakness is supporting precious metals. Energy inflation could threaten that support. And underneath all of it sits the enormous U.S. debt burden. That is why the next phase could be much more important than the initial announcement. Because if Treasury intervention continues while the Fed remains constrained by inflation, the market could be heading toward a policy conflict that has direct consequences for bonds, the dollar, gold, and silver. And the outcome of that conflict could determine whether the precious metals market is entering another major leg higher or preparing for another sharp correction. The next few weeks could tell us whether this Treasury announcement was simply a short-term market catalyst or the beginning of something much bigger. And for gold and silver investors, the answer will come from watching several markets together, not from watching the metals alone. The first thing I would watch is the long end of the Treasury curve. The reason is simple. The Treasury has already demonstrated that it is willing to step into the market and increase purchases of longer-term debt when borrowing costs become uncomfortable. The immediate effect was clear. Bond prices moved higher, yields moved lower, and gold responded sharply. But the real test comes afterward. Can long-term yields remain contained, or does the bond market eventually push them higher again? If yields stay lower while the dollar remains weak, the environment remains supportive for gold. Lower yields reduce the opportunity cost of holding a non-yielding asset, while a weaker dollar can increase the dollar-denominated price of gold. Those two mechanisms were operating together during this week's rally. And that creates our first scenario. Imagine the Treasury continues supporting the long end, the dollar remains under pressure, and investors continue moving toward precious metals. In that environment, gold could remain structurally strong. Silver could potentially move even faster because it combines the monetary metal story with industrial demand. The source reports that silver gained more than 5% during the week and moved back above $70, while gold gained roughly 3%. But there is another scenario that we cannot ignore. What happens if inflation returns? That is where oil becomes extremely important. The source identifies the US-Iran situation and the Strait of Hormuz as a major risk. If geopolitical escalation pushes crude significantly higher, inflation expectations could rise again. And if that happens, the Federal Reserve could become more hawkish. Remember what happened earlier in the year. According to the source, the previous oil shock pushed inflation expectations higher, caused markets to price a more aggressive Federal Reserve, and contributed to a major gold correction from its earlier high. That historical sequence gives us a very important warning. Gold is not automatically bullish simply because geopolitical risk is increasing. If geopolitical risk pushes oil higher enough, the resulting inflation can become more important than the safe haven demand. And that is why the September Federal Reserve meeting matters so much. The July meeting produced a 9-3 vote to hold rates at 3.5% to 3.75%, with 3 members arguing for higher rates. So we have a genuine policy conflict developing. The Treasury wants to keep long-term borrowing costs manageable. Some Fed officials are prepared to tighten monetary policy if inflation demands it, and the market has to price both forces simultaneously. That means I would not make a gold forecast based on the Treasury announcement alone. I would watch 4 things together: the 30-year Treasury yield, the US dollar, crude oil, and gold itself. If the 30-year yield falls, the dollar weakens, oil remains controlled, and gold holds above its breakout area, the bullish case becomes considerably stronger. If yields rise sharply, the dollar strengthens, and oil pushes inflation expectations higher, the environment becomes much more difficult for precious metals. Silver requires even more caution because of its volatility. The source explains that silver's smaller market size can amplify both rallies and corrections. So if silver continues higher, I would want to see the move supported by sustained demand, rather than simply one explosive session. And there is one long-term factor that remains particularly important: central bank gold buying. The source reports 288.9 tons of central bank purchases during the second quarter of 2026, described as a quarterly record. That tells us something important about the broader gold market. Central banks are not operating on the same time horizon as short-term traders. They are thinking about reserves. They are thinking about diversification. They are thinking about purchasing power over years and decades. So when strong central bank demand exists alongside concerns about government debt and currency stability, gold's long-term narrative becomes much more substantial. And that brings us back to the original Treasury announcement. The biggest takeaway isn't simply that gold went above $4,500. It isn't simply that silver jumped above $70. And it isn't even that Treasury yields dropped sharply for one session. The bigger takeaway is that the relationship between U.S. government debt, long-term interest rates, the dollar, and precious metals is becoming increasingly visible in real time. For years, these relationships were discussed as theoretical macroeconomic concepts. This week, we watched the mechanism play out. Treasury increased its purchases of long-term debt. Bond demand increased. Yields fell. The dollar weakened. Gold surged. Silver surged even more aggressively. That's the connection. And now the market has to answer the next question. Can policymakers keep the long end of the bond market under control without creating a new problem somewhere else? Because if they can, markets may continue enjoying lower yields and stronger risk appetite. But if they cannot, then the adjustment has to appear somewhere. It could appear through higher yields. It could appear through a weaker dollar. It could appear through inflation. Or it could appear through increasing demand for assets outside the traditional fiat system. And that is exactly why gold remains so important. Gold doesn't depend on a government promise to pay you interest. It doesn't depend on corporate earnings. It doesn't depend on a central bank deciding to maintain its value. Its role is fundamentally different. And silver adds another dimension because it combines monetary characteristics with real industrial demand. So my conclusion is this: don't focus only on the headline. Watch the confirmation, watch the 30-year yield, watch the dollar, watch oil, watch the Fed, and most importantly, watch whether gold and silver can hold their new higher levels after the initial treasury-driven excitement fades. If they can, then the market may be telling us that this is no longer just a temporary reaction to a bond buyback announcement. It could be evidence of a much broader shift in how investors are thinking about US debt, currency purchasing power, and hard assets. But there is still substantial uncertainty. The source itself identifies energy-driven inflation and a more hawkish Federal Reserve as major risks to the bullish metals thesis. So don't confuse a bullish macro framework with a guaranteed price prediction. Markets can reverse, yields can rise, the dollar can strengthen, oil can surprise, and silver can correct much faster than gold. This is why the objective is not to predict every move. The objective is to understand the mechanism well enough that when the next major move happens, you know why it is happening. I'm Alex James, an independent economic gold and silver analyst, and this is Macro Bullion. This analysis is for educational and informational purposes only and is not financial advice. Do your own research, verify the latest data, understand the risks, and never make an investment decision based solely on one market narrative. Because the real story isn't simply that gold crossed $4,500. The real story is that the US Treasury just reminded the market how important the cost of America's debt has become, and gold and silver may be among the first markets telling us what that means.